Mr. Ranjan Dhawan, Executive Director of Bank of Baroda, which is BOB. He joins us live. Mr. Dhawan, good morning. Thank you for joining us. Now, Reserve Bank of India yesterday has decided to play it safe. They've cut the repo rates, but they've done nothing when it comes to CRR. So, as a banker, are you slightly disappointed?
No, not at all. I am not disappointed at all. The liquidity problem which is occurring at the end of March is normal for this time of the year. It occurs every year. As far as the cutting of rates go, you must also, the Reserve Bank doesn't have any magic wand as to bring rates down. The 10-year bond yields, in fact, since yesterday have firmed up today in the morning to 7.92. And I don't think there was much headroom to cut rates further. The market has already decided, the yields are market determined, and the markets were not showing any downward trend in yields. You must remember that last time the bond yields were cut, the repo rate was cut, bond yields which had been hovering at about 8.15 dipped to about 7.9, 7.85. Therefore, I at that time felt that, rate cut was on the cards. This time, the bond yields have been far more stickier. So therefore, I don't think, I am particularly disappointed about it. Secondly, I would also like to add that the inflation, headline inflation, and especially food inflation is still well over 10%. Though, of course, the core inflation has gone down below 4%, the overall inflation is fairly high, which does not bode well for the economy. So I think the 25 basis cut that came through is quite in order.
So as a banker, does the 25 bips repo rate cut give you some space to cut your lending rates as well? And would you be doing that anytime soon?
No, I'm afraid we will not be doing that anytime soon. These things take a little time to work into the system. This is, as I said, the end of the financial year. Let us settle down. Let us see what the repo cut has, what effect it has on the market, and whether deposit rates come down as a result. I think probably we would like to take a call sometime middle of next month.
Mr. Dhawan, the Reserve Bank of India in their defense is now making a case that Indian banks are enjoying very strong NIMs, and if they want, they can pass on the rate cut.
We also are doing a lot of lending to all sorts of sectors of society where our, NIMs are very, very low. So also we have to, shore up our capital. I don't think in the context of the overall economic scenario, our NIMs are all that high.
3% for Bob, whereas I'm glad that you've maintained a 3% NIM, but there is some room to take a hit there.
I beg your pardon?
No, I'm talking about your NIM number. Currently, your NIMs, as per your as per your quarterly numbers, are well above 3%. So, whereas I'm happy and secretly I want to applaud you that you're maintaining a NIM of above 3% plus, but you can easily take a hit of about 50 bips there or 25 bips there.
You see, we are also 30% of our bank's balance sheet is global. And global NIMs are much lower. Most of the lending is in terms of trade finance, where NIMs are very tight. So overall NIM for the bank is well below 3%, is below 3% in fact.
You have a high exposure to the infrastructure sector as well, and the RBI has recently stated that, banks can treat exposure to PPP infra projects as secured. What is your view on this?
I think, many of these infrastructure projects are held up for want of proper coal, proper gas, or environmental clearances. The infrastructure projects, by and large, are very sound. The security is there, the assets have been built up, but some of them are facing hurdles by way of clearances. I think some action is required on various agencies' parts to clear the hurdles for smooth takeoff of these projects.
But will it in any way affect or dampen your asset quality?
No. You see, we do have restructured loans as a consequence of all this. Restructured loans are mounting up. There is no doubt about that. But very real assets have been created. For example, if a power plant has been created, the boilers are there, the land has been acquired, the the generators have been put in place. I would assume this is a temporary phenomena, and I think the government is seized of this problem, and a serious debottlenecking process has begun, which I hope will make these problems alleviate over the future. Yes, in the short run, there is no doubt that our level of restructured loans have gone up.
Do you think your book quality has genuinely turned the corner? What I'm trying to gather from you is that have bad loans now started becoming good loans?
I always emphasize one point, and that is that when the economic slowdown occurs, NPLs start occurring on the books after about a year. They don't occur immediately. Companies have built up reserve, they have cash reserves, they have, existing orders. When the economic downturn occurs, it takes about a year to, start appearing on the books. Similarly, when the upturn appears, I would imagine that asset quality, whatever trend has been there for 2 or 3 quarters, will maintain for the next 1 or 2 quarters more, and after that I expect an uptrend to occur.
The bond yields for the first quarter of this year has been rather volatile. First they cracked and then they recovered. What does that mean for your portfolio?
I didn't get you.
I'm trying to understand about your bond yield or your total, your government portfolio. Beginning of the year, bond yields came down. Now bond yields have gone up. How will that change your fund-based income?
It will not in any significant way change, because bond yields at the moment are range bound. They are hovering around the 7.9% marks, and let us see what they do at the end of the financial year. Bond yields also are dependent upon the market, and there is a liquidity tightness over there. I expect this. There is some balance sheet management going on in all banks. I expect the bond yields to soften towards the end of this month, and they will not. I don't expect any substantial impact by the end of the month. These are essentially market driven, and what the market is seeing is still the economy is prone to high inflation. We have seen in the last year that there has been a shift to asset classes such as gold. A lot of gold buying has occurred among investors. I expect that as inflation moderates, and it is starting to moderate, as some growth creeps into the economy, there are general consensus is that growth next year will be about 6.5% GDP growth will be there next year. I imagine that the effects will start creeping in the balance part of the year. And it may take 1 month, it may take 2 months, but I imagine over a quarter, the next 1 or 2 quarters, the situation would moderate substantially.
Mr. Dhawan, really good chatting with you. Appreciate you taking the time out and joining us on the show today.